picture this. It is February 1st, 2026. You were just, watching the crypto markets. And a trader known in the space as the 1011 Insider Whale makes this massive, highly leveraged bet.
Right. They are betting big that Bitcoin is about to just surge.
Exactly. The stake is completely enormous. But the market dips. And because of the insane leverage, that slight dip triggers a catastrophic $700 million forced liquidation.
Which is just staggering. I mean, it's the kind of systemic shock that usually leaves a massive trail of destruction across a trading platform.
Yeah, or at the very least, it results in a huge payday for the corporate entity or the CEO running whatever centralized exchange is handling the position.
Yeah, typically that's exactly what happens.
But that is not what happened here. Instead of that money being just absorbed by a CEO somewhere, a group of everyday crypto users who had effectively pooled their funds to act as the house, well, they split roughly $15 million in pure profit.
In a single day.
Right. In one single day. That specific event secured those everyday users a 110% annualized yield on their deposited assets, which is wild.
It really is. And I think it perfectly illustrates this massive structural shift in how decentralized finance is operating at the bleeding edge right now. I mean, the mechanics of who wins and who loses are just being completely rewritten.
And the platform behind this sort of invisible casino is Hyperliquid. So, welcome to today's deep dive. Today, we are looking under the hood of a completely bespoke blockchain, one entirely free of traditional venture capital, which is rare.
Very rare, yeah.
And this platform somehow managed to capture over 70% of the decentralized perpetuals market. We are talking about a system processing up to $15 billion a day.
Which is no small feat.
Definitely not. Because, to process a $700 million liquidation without the platform just freezing or suffering massive slippage, it requires an architecture that abandons almost everything we thought we knew about decentralized networks.
Right, with slippage being the key enemy here. For anyone listening who might not day trade, slippage is basically the hidden tax of a slow network.
Right.
It's that gap between the price you expect to get when you click buy or sell and the price you actually get because, well, the market moved while your order was stuck in traffic.
Stuck in traffic is a great way to put it. Because if you are trying to run a high-frequency derivatives exchange on a general-purpose blockchain like Ethereum, for example, you are essentially trying to race a Formula One car in rush hour city traffic.
That is exactly what it's like.
You can have this incredibly engineered financial machine, but you are stuck competing for lane space with someone minting a picture of an ape.
Right, or someone just sending a $5 payment to their friend.
Exactly. You just cannot get up to speed.
And so the team behind Hyperliquid looked at that rush hour traffic and realized they couldn't just build a better car. They had to actually pave their own private racetrack where only financial transactions are allowed to drive.
The completely custom chain.
Exactly. They built a bespoke layer 1 blockchain completely from first principles, and it's heavily focused on a custom consensus algorithm called HyperBFT.
Which operates on this concept called optimistic responsiveness. I found this fascinating in the source material because it completely changes how the network agrees on what's happening, right?
It does. So most traditional blockchains operate on a strict ticking clock. Think of it like a metronome.
Okay.
Ethereum, for example, has a block time of about 12 seconds. The validators, the computers securing the network, they literally have to wait for that 12-second tick to agree on the state of a network and process a batch of trades.
But they're bound by that artificial clock.
Right. But optimistic responsiveness throws the metronome completely out the window. It allows the network to process transactions as fast as the validators can physically communicate with each other over the internet.
Wait, so the speed limit is no longer the software itself. It's just the physical speed of the internet cables connecting the nodes.
Exactly. And that translates to sub-second finality. We are talking about 0.2 seconds to finalize a block.
Wow. 0.2.
Yeah, and that allows the Hyperliquid network to handle up to 200,000 orders per second.
That is that is Wall Street speed. So they paved this lightning-fast racetrack.
Yeah.
But they didn't just build one engine for it. They actually built a dual-engine system to run on this track, right?
Yeah.
HyperCore and HyperEVM.
Yes, and this separation is really what makes the architecture so potent. So HyperCore is the first engine. It runs the fully on-chain central limit order book, or the CLO.
Which basically acts exactly like the high-speed matching engine of a centralized exchange like Binance or even the New York Stock Exchange.
Exactly. Every single order, cancellation, and liquidation happens natively on-chain with deterministic price-time priority.
Meaning the first order to arrive gets the price, period.
Right. You cannot just pay a higher gas fee to jump the line and execute your trade ahead of someone else, which, as we know, is a massive problem on older decentralized exchanges.
The dreaded MEV bots.
Exactly. Here, there's no hidden backroom matching, no paying for priority. It's just fair. But then you have the second engine, which is the HyperEVM layer.
Right, the Ethereum compatible side.
Yeah. This is an environment that allows third-party developers to write smart contracts and build entirely new applications that just plug seamlessly into HyperCore's deep liquidity.
And for you listening, the reason this dual engine setup matters so much is that it fundamentally solves the trilemma that plagued early crypto exchanges.
It really does.
You get the lightning-fast execution speed of a major Wall Street-style platform, but because it's a custom chain, you pay literally zero gas fees for trading.
Zero.
And most importantly, you maintain total self-custody of your funds in your own Web3 wallet.
Yeah.
You are never handing over your private keys to a centralized CEO who might, gamble away user deposits.
Yeah, we've definitely seen that happen before. So it basically gives you the performance of centralization with the actual security guarantees of decentralization.
Okay, let's unpack this a bit more, though. Because building a super fast engine is great, but it doesn't automatically mean people will actually show up to trade on it.
No, it definitely doesn't.
Which brings us to how they actually attracted trillions of dollars in annualized trading volume without a massive venture capital marketing budget. They didn't do the traditional Silicon Valley blitzkrieg at all.
No, they completely flipped the tokenomics model. And honestly, it really starts with the founder, Jeff Yan.
Right, so he has a background in mathematics and computer science from Harvard. But more importantly, he previously worked at Hudson River Trading.
Which is one of the absolute most elite high-frequency trading firms in the world.
Right.
In traditional finance, firms like Hudson River Trading, they spend millions of dollars just to move their physical servers a few feet closer to the stock exchange, just to shave a single microsecond off their execution time.
It's an obsession with speed.
Yeah.
So he takes that obsessive sub-millisecond mindset and brings it to crypto by founding a market-making firm called Chameleon Trading.
Right. And Chameleon was highly successful during the crypto bull runs. So rather than going around pitching venture capitalists for seed money, Jan and his team just used Chameleon Trading's profits to bootstrap Hyperliquid completely in-house.
Which is just a massive divergence from the crypto norm. I mean, usually a VC firm funds the development, and in exchange, they get a huge percentage of the platform's native token at a microscopic price.
Yeah, and then when the token launches to the public, the VCs dump their bags on the retail users to secure their profit. We see it all the time.
Right, but because Hyperliquid had literally no VCs breathing down their neck, when they finally launched their native token, HYPE, in late 2024, they orchestrated one of the largest user-centric distributions in crypto history.
They really did. They did a Genesis airdrop, giving 31% of the total 1 billion token supply directly to 94,000 early users.
Which equated to about $19,000 per user on average.
It's incredible. It generated just a massive amount of organic loyalty. But, giving away tokens is only half the equation. They paired that distribution with a relentless deflationary engine known as the buyback flywheel.
Right, the flywheel. This is where roughly 93% of the protocol's total revenue flows directly back to token holders.
Exactly. Every single day, the protocol takes 97% of the trading fees it generates and uses them to buy back HYPE tokens on the open market,
creating this constant, massive buying pressure. The sources mentioned the protocol has accumulated over $1 billion worth of HYPE in its assistance fund just through these daily buybacks.
Yeah, it basically treats the token less like a speculative asset and more like a direct claim on the platform's actual cash flow.
Okay, I need to push back here for a second, though. Let's go back to that HLP vault we talked about in the very beginning. The hyperliquidity provider vault that absorbed the whale's $700 million loss and somehow made a profit.
Right, the invisible casino.
Yeah, because if I am just an everyday user and I deposit my USDC stablecoins into that vault, I am literally taking the other side of a professional whales trade.
You are.
That sounds an awful lot like playing Russian roulette with my savings. How is that fundamentally safe?
Well, you are taking on inventory risk. I want to be clear, the HLP vault is definitely not a risk-free savings account.
Okay, good to clarify.
But the system is designed to democratize market making. It gives everyday users the structural advantages that usually only Wall Street firms enjoy. When you deposit into the HLP vault, you literally become the house.
Right.
And the house generates yield in 3 very distinct ways.
Break those down for us. What's the first way?
First is maker fees. Because the vault is providing the liquidity that allows other people to trade, it just gets a small cut of the trading fees.
Okay, that makes sense. And the second?
Second is funding rates. So the vault acts as a stabilizer. If, say, 90% of the market is betting that Bitcoin will go up, the vault takes the unpopular side and bets it will go down.
To balance the market out.
Exactly. To keep things balanced, the people on the overcrowded side actually have to pay a continuous fee, the funding rate, to the people on the minority side. So the vault gets paid just for sitting there and balancing the scales.
Wow. Okay. And the third way is the liquidation premium, which is the mechanism that caught our insider whale in the hook, right?
Right. Exactly. When a trader's leveraged bet goes bad and their margin falls too low, the system automatically steps in and forcefully sells off their collateral to prevent the platform from taking a loss.
The forced liquidation.
Yeah. And the HLP vault gets to step in and acquire that bankrupt trader's position at a steep discount.
Oh, I see.
Then the vault simply turns around and unwinds that position at the real market price. The difference between that discounted acquisition cost and the real market price is pure profit.
And 100% of that profit goes to the everyday users who deposited into the HLP vault.
Exactly. So because of those structural advantages, the make-all fees, the funding rates, the liquidation discounts, over a long enough timeline, the house edge just wins out.
Okay, so providing revenue streams like that obviously keeps your existing users incredibly sticky, but to actually expand market dominance, Hyperliquid is doing something totally different. They essentially pay third-party developers to build new doors into their ecosystem.
Yes, using something called builder codes.
Here is where it gets really interesting. A builder code is essentially an on-chain revenue attribution mechanism, right?
Exactly. So if you are an app developer, you can integrate Hyperliquid's entire trading engine directly into your own app's interface.
Seamlessly.
Right. And when a user makes a trade through your app, your specific builder code is attached to the order, and you earn a percentage of the trade value, up to 0.1% on perpetual contracts.
And the most prominent example of this in action is the Phantom wallet, which is a huge player in the space.
Oh, definitely. Phantom integrated Hyperliquid natively into their wallet interface. So a user never even has to visit the Hyperliquid website. They just trade right there inside their wallet.
And because of that builder code, Phantom is earning roughly $100,000 a day in builder fees.
They are making $100,000 a day. Yeah.
And they are not charging their users a subscription fee. They're just taking a tiny slice of the trading flow that they direct to Hyperliquid's deep liquidity.
It perfectly aligns the incentives of the wallet providers, the developers, and the core exchange. And Hyperliquid is leveraging this rapidly growing developable ecosystem to expand the types of assets you can actually trade.
Which brings us to a major network upgrade known as HIP-4.
Right, the Hyperliquid Improvement Proposal. So HIP-4 introduces outcome contracts, which is just the technical term for prediction markets.
So we are talking about betting on binary events, like will the Federal Reserve cut interest rates by 50 basis points?
Right.
Or who will win the presidential election? Or even, will a specific movie gross $1 billion?
Exactly. And if we connect this to the bigger picture, prediction markets have exploded in popularity recently. They saw over $63 billion in volume in 2025 alone.
$63 billion, that's huge.
But historically, they have existed in total isolation. You know, you have your crypto trading portfolio on one platform and your political or cultural prediction bets locked up on a completely different website.
Yeah, they're scattered everywhere.
But HIP-4 natively integrates these binary prediction markets directly into Hyperliquid's core trading engine.
But wait, I have a question about this. Because Hyperliquid already built a massive permissionless perpetual futures engine under a previous upgrade HIP-3, I think.
That's right.
And you can theoretically create a perpetual contract for almost any asset. So if I want to bet on an election, why can't I just spin up a standard perpetual contract for it? Why invent a completely new architectural standard?
It's a great question, and it really comes down to a fascinating mechanical limitation in how standard perpetual contracts safely process real-world data.
Okay, lay on me.
So under HIP-3, perpetuals have a built-in safety governor. The price is only mathematically allowed to change by a maximum of 1% per oracle tick.
Okay, so every time the blockchain basically pings the external world for a price update, the smart contract will only allow the asset's price to move 1% up or down.
Exactly. Now, for a normal asset like Bitcoin or gold, that safety limit is perfect. They rarely jump more than 1% in a fraction of a second, and it prevents flash crash manipulation.
That makes total sense for crypto.
Right, but a prediction market is a binary event. It doesn't slowly trend upward. It resolves from a probability, say, a 50% chance of happening, instantly, to a 100% certainty the exact second the real-world event occurs.
Right. If the event happens, the price needs to instantly double to reflect reality.
But if that binary bet is trapped inside a standard perpetual contract with that 1% tick limit, it cannot jump instantly.
Oh, I see.
It would have to inch its way up, 1% at a time, update after update. To get from a 50% probability to a 100% certainty, it would take roughly 50 sequential oracle ticks.
Wow. And even at Hyperliquid's blazing speed, how long does that take?
That process takes about 50 minutes to fully settle on-chain.
That is a mechanical disaster. I mean, for 50 minutes, everyone watching the news knows the event has already happened, but the smart contract is slowly chugging along, trying to catch up to reality.
Exactly. And it creates a massive 50-minute arbitrage window. Sophisticated, high-speed trading bots would swoop in, buy the contract at the artificially constrained low price from everyday human traders.
And essentially steal the value from the existing position holders who are just trapped waiting for the settlement to finalize.
You got it. So HIP-4 solves this by creating a totally new contract structure explicitly for these events. There are no continuous oracle ticks trying to track a moving price.
So how does it settle?
When the real-world event resolves, the contract simply jumps directly to the final settlement value, which is paid out in USDH Hyperliquid's native stablecoin.
No more inching up 1% at a time.
Right. And because these outcome contracts are fully collateralized, meaning you have to put up the full dollar amount of your bet, there is zero leverage involved.
Which means zero liquidation risk.
Exactly. You post your dollar, and you either lose it or win the payout. But the real magic here is cross-margining.
What does that mean for the user?
Because the prediction markets and the crypto futures are running on the exact same layer 1 engine, you can share your capital across both.
Oh, wow. Meaning you can use your unrealized profits from, say, a winning Ethereum trade to automatically fund a bet on the Federal Reserve.
All from the exact same pool of money. You never have to bridge funds or manage separate accounts. It represents just a massive leap forward for capital efficiency.
Okay, so we have established that this platform is a blazing fast, highly profitable machine with cutting-edge market architecture. It's generating massive yields for everyday users and developers.
Yeah, the tech is undeniably impressive.
But when you have billions of dollars in daily volume flowing through a custom-built network, we have to look at the dark side. So what does this all mean when things go wrong? Who actually holds the kill switch?
This raises an important question, and it really is the core tension at the heart of Hyperliquid's design. It's that fragile balance between speed, safety, and true decentralization.
Because looking at the sources, the decentralization claims require some serious scrutiny. 5 validators, operated by the Core Hyper Foundation, control over 81% of the staked tokens on the network.
Yes.
And industry leaders, like Kyle Samani from Multicoin Capital, have publicly criticized the platform, calling out its highly permissioned architecture and closed-source elements.
And they aren't wrong to point that out. A highly concentrated validator set is the literal mechanism that allows the network to process 200,000 orders a second.
Right, it's a trade-off.
Exactly. You simply cannot achieve sub-second finality if you have to wait for hundreds of thousands of independent, globally distributed validators to agree on a transaction, which is how Ethereum operates.
But consolidating that much power into 5 core validators introduces massive trust assumptions.
It does. And that trust was put to the ultimate test in March of 2025 during an event the community refers to as the Jelly Incident.
Okay, let's break this down. The Jelly Incident.
It's the perfect case study for this philosophical tension. So Jelly was a meme coin trading on the platform. It had a relatively small market capitalization of around $25 million.
Pretty small for crypto.
Right. And an attacker stepped in and aggressively manipulated the spot price of Jelly, driving it upward by an artificial 429%.
Just a massive pump. And then they used that artificially inflated value as collateral to take out massive leveraged positions on the network.
Yes, and this creates what risk engines call unpriced risk.
Meaning what exactly?
Well, the protocol's automated systems look at this and think this trader has deep, valuable pockets based on the inflated price of jelly. But the liquidity isn't actually there.
It's a mirage.
Exactly. And when the price inevitably starts moving so fast that the standard liquidation mechanisms begin to fail, the protocol is left holding bad debt.
Which means the HLP vault, that community pool we discussed earlier, which had over $200 million of user funds deposited in it, was suddenly in the crosshairs.
It was at risk of being completely drained to cover the attacker's manipulated debt.
So the house was about to go bankrupt because of a manipulated meme coin.
Exactly. Faced with the potential collapse of the community vault, the core validators stepped in and took manual action.
What did they do?
In just 2 minutes, the 5 validators achieved consensus to completely delist the jelly asset from the platform and force the settlement of the attacker's positions at a specific, predetermined price.
Abruptly stopping the bleeding.
Yeah.
They essentially pulled the emergency brake on the entire market.
They did. Now, objectively speaking, this centralized intervention saved the HLP depositors from catastrophic financial losses.
Right. The community vault survived,
Yeah.
and the platform kept operating.
Yes. But it fundamentally contradicted the ethos of pure decentralization. I mean, in a strict code is law environment, if the smart contract mathematically allows a clever attacker to drain the vault, well, the vault gets drained.
The code is the code.
Right. But by stepping in, the validators proved that they had both the technical power and the willingness to override the free market.
Now, to be fair, Hyperliquid has since implemented much stricter leverage caps and automated risk parameters to prevent a similar attack from happening again.
They have, yes.
But the underlying reality of that centralized validator power remains untouched.
It does. And I think it's arguably the most ambitious and polarizing experiment in on-chain finance today. They aren't just trying to build a marginally better decentralized exchange.
No, they are attempting to build a foundational operating system for the moment when traditional global finance eventually migrates onto the blockchain, which really leaves you, the listener, with one final provocative paradox to consider today. Hyperliquid's ultimate vision is to replace the traditional financial system. But when faced with an existential threat during the Jelly incident, Hyperliquid survived by acting exactly like the traditional institutions it was built to replace.
They manually pulled the circuit breaker.
Exactly. It leaves you wondering, if true decentralization means sitting back and letting an attacker legally drain your community's money, is a little bit of centralization exactly what decentralized finance needs to finally go mainstream? Or will the future of DeFi just end up being the exact same traditional Wall Street casino, simply running on much faster servers? Something to mull over. Thanks for joining us on this deep dive.